Did I do something? Maybe I muted myself. That would suck because I think I just unmuted myself. That's what I get for touching things. Those with great credit will now be penalized to subsidize those with bad credit. Okay. Okay, cool. So LinkedIn user, except for the fact those with great credit will now be penalized. It's not, that's just not that they're penalized necessarily. Things won't be as good for them. That's for sure. You know, the thing that sucks about that, man, I'm sorry about the audio. It's such a bummer. So rarely I get to do these. And then of course the audio is not working. So the truth is that people who had those lower credit scores, the rates were just absurdly higher. I mean, absurdly higher. We just go off the charts where they really couldn't even get a par rate. So like if you had a, even though you're supposed to be able to get a Fannie Mae mortgage with a 620 credit score, if you had below 680 really, but particularly 640, the rate would be so high and you would have to pay points to get that rate. I mean, it's just dramatically off a cliff, crazy. So I've always said, like, either they should just say, hey, we're not going to give these people loans at these credit scores, like just have a minimum credit score, or, you know, do something like this, like make a change. So I wouldn't have made this change personally, but the change has been made. It is what it is. Interest rates are going to be more synonymous now across the board versus the gigantic differences that we had. Now, mind you, this type of pricing scenario has existed in the government side for FHA and VA for quite some time. So like with FHA and VA, if you have a 640 or higher, basically you're getting the same rate pretty much. Very slight changes. If you're below 640 though, it goes off a cliff. So that's kind of the difference. Now, what it seems like to me is that we're heading in that direction for Fannie and Freddie too. We're heading in that direction where, hey, we want to see a certain credit score. Once you're there, then you're going to get some love. But look at this right here. It particularly says right on this, less than 639, they're going to give you a bump. So if you can get a DU approval and you have a 620, you're going to get a bump. It will help those people buy homes. So this isn't something to really be too angry about. It is actually sort of commonplace. Should they be doing things like this? No, they should not. And the reason is because ultimately, this is a bond-driven market, and you really need to make it make sense in the bond market. And the more you play with it here, the less sense it makes. Also, keep in mind, it's still entirely possible. Now, this is for Fannie Mae, the loans that Fannie Mae is going to purchase. But what about on the secondary market? What about someone else who's buying paper? Are they going to be willing to buy that 630 credit score conventional loan? Probably not. So the danger here isn't really in like someone getting screwed or someone else getting a leg up that's unfair. It's really in the government by creating this, making themselves the biggest buyer, and the rest of the market wants to buy the better paper, and the government ends up with all the 622 credit conventional loans. So now Fannie and Freddie are holding a sack of crap. And if things go south in real estate for some reason, which I don't foresee, but that would leave them in a much more vulnerable position. So that's the real danger here. If we're really talking about what's dumb about this, is that the secondary market is not going to want to play in this charade. So originators will, companies will originate these loans. They'll sell them to Fannie, sure. But will other servicers buy that crappy paper? I really doubt it. Really, really doubt it. All right. So I think we're back online. I had muted my microphone is what happened. Never done that before. Didn't know you could do it. I touched it. I muted it. Sorry about that. Look at that housing forecast here for Fannie Mae. Now, I showed you the one in February. This is the one for April. What happened here is that they actually revised a few things. Let me move this also. Get this out of here. There we go. They revised a few things, and I think it's interesting to note what's been revised. So here we make a note that here's your average interest rate, right? 30-year fixed mortgage here, home price index here. Okay, so these are the two lanes that we're really looking in right here, these two. Now, this stuff, 2022, this has already happened. Okay, so we have this whole column here. This is factual data. The stuff that's grayed out is a projection. So you can see for the first quarter, average rate ending was 6.4%. Look what they're projecting here. They're actually projecting pretty much the same, but the rates will get down to 5.2% on average by the end of 2024, which is about 1.25% lower than where we're at today. And look at that nice, slow, steady decrease in rates that they're expecting. What changed, though, that hasn't changed a whole lot. What did change is their projections for real estate values. Remember when they had 4 and 5% negatives on here in February? Go back and watch that video. Not that many videos to go through anymore. So you go back and watch that video. They're saying, oh yeah, 3, 4, 5% declines. And now they're saying, oh, wait a minute. First quarter 2023, we're actually expecting 4.5% pop. Oh, it's interesting. Yeah. But then Q2, you're going to start to feel it. 0.1% negative. And then the next quarter, 0.8%. It's really accelerating now. 0.1, 0.2% Reventure Consulting is happy. No. So this is what now they're showing this, hey, minus 2%, minus 2%, minus 2%. I believe they're overly bearish. I believe that back in February when I told you their numbers were wrong and didn't make sense. And I still believe that because, again, there's conflicting information. And which one of these two things does Fannie Mae have more control over or have more insight on? 100% rates. 100% rates. They know very little and have very little insight over what's going to happen to real estate values. Just like nobody really knows what's going to happen, right? But when it comes to mortgage rates, they have a lot more insight on that. A lot more. What's going on in that bond market. So I believe that we can trust their projection of interest rates much more so than we can trust their projection of home prices. And you'll note the revisions that have taken place are about home prices. Why are they revising them? Because they're seeing the data come in. This, I believe, was negative back in February. Now look at it. 4.5%. Why? Because they're seeing that's coming. The data's coming out soon. They'll probably be exactly that. It just hasn't been confirmed. That's why you see this 6.4 is whited out here because it's not a projection. The projections are in gray. This will soon be whited out and it'll probably be really close to 4.5%. Okay. So Fannie Mae, not that we could just look at it and just trust and take the information to the bank, but it's very interesting to see how they revise things so we know what direction they believe things are going from what they're seeing, right? Okay, quick here. Snapshot of rates. Let's refresh this quick. My rates are about 0.25% or more in this case, lower than these. Housing forecast. Today's data was actually interesting. Got the Case-Shiller home price index is year over year, right? Up 0.4%. Met expectations. Okay. Previous year over year was 2.5. Don't really look at that. Doesn't really matter. Met expectations of 0.4. New home sales, much higher. Now, mind you, that's new home sales. So the reason why I want to point that out and the reason why that's important is I'm going to be building a very bullish case for real estate for you. And I will continue to, because it's the correct side to be on. You do not want to be on the side of hating on real estate right now, because you will look like a fool at some point. Maybe, the market will go down for a few months and you'll look like a genius, but for years and years to come, you will look like a fool. So if you're telling people not to buy real estate or you think the market's weak or it's going to crash or something, you had best make sure you get really loud and announce when you think it's changed. Otherwise, those people will just think you're a fool. And there's been plenty of people who said that over the past handful of years, and all of them look like fools. A fool I will not be. So new home sales, the reason why that's important is because new homes are the most expensive. It's the most expensive product that we have in our real estate market is brand new homes. Builders want to milk you for every dollar possible. I have a client right now who's writing offer on a new build. They don't even have any other offers. and they countered her back higher. Like they just don't care. And I talked to her about it, and I said, well, what does your agent think? And we went through this. It's like, well, I would say, you could just stand from your offer, or you know what, maybe just go silent on them for 48 hours. The downside is someone else might come in and buy it. That could happen. But new homes being purchased at a higher rate than expected, like this, that's a pretty significant jump right there. If you look at that, that's what, 40,000, almost 50,000 homes. Yikes, man, that's like 8% jump. So it means these new homes are getting scooped up. That means that buyers are willing to pay top dollar, because when you're buying new construction, you're paying top dollar. That's what's happening. So buyers willing to pay top dollar is a very bullish sign. Consumer confidence overall lower. And this is part of the reason also that I'm bullish, because we have higher rates, right? We have low inventory environment. We have all sorts of geopolitical things going on. We have a dead man as a president. We have all sorts of crazy things happening in the world. And yet look at real estate. So when I see, hey, consumer confidence is down, and I agree it's down. People I talk to are scared. A lot of people are like, I don't know if it's the right time. We're going to get to some common questions here in a second. If you have any, we're live on Facebook, LinkedIn, Twitter, YouTube, etc. Drop a question if you want. We'll go through it. I got the most common ones that I'll go through momentarily, and then we'll do rates after that. But confidence is down. And when confidence is down, you would expect the market to suffer, right? If the confidence in whatever, Tesla's self-driving, what if those cars were wrecking all over the place? Tesla would get murdered. The stock would get murdered. The company would get murdered. But when confidence is down and a market holds, doesn't have to thrive, even just holds, then that's a very strong signal. What do we have in Q1? 4.5% year over year. That's with increased interest rates. And this isn't exact yet, but they're projecting 4.5, and it's already April. So that, my guess is they already know this number. That is a really strong sign, guys. Really strong sign. So I just want to keep that in mind as we're looking at these things. Now, what happened here, we're going to look at stocks quick. So today, the market got obliterated. You can see it the best on a 5-minute chart. This is today, right here. Gap down, and then see you later. Down, 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 down. As I was watching this unfold today, I was like, man, that's some really ugly price action. I mean, we haven't seen price action this ugly, the S&P, for a minute. We've had some sideways days and things like that, but we haven't really just seen just an all-out horrific sell-off. But it felt very controlled. And if you look at this, you can kind of see just how controlled it was. Okay, let's just look at this for a second. Does that look engineered at all to you? Or does that look like an actual market participation situation? Looks pretty engineered, right? I mean, they guided that thing right down the tunnel. And usually when market makers guide a price lower like this, it's because you're going to see prices go higher soon. It's essentially a bait. They're trying to bait shorts in, and they're buying and accumulating on the way down because they're going to rip people's faces off. They're going to rip the shorts' faces off. And then, so we saw this. I saw this very controlled sell-off going on. And then after the bell, Alphabet reports revenue beat for Q1, and they authorized a $70 billion stock buyback. Holy bullish Batman. Microsoft also beat, and then Chipotle beat big. So you had some big names beating hardcore after the bell. And also Google's cloud business turns profitable for the first time. So here we have this sentiment that's sort of heavy. We have this sell-off that's sort of ugly and just but when you look at it, you can really see it is 100% engineered. It's controlled. I call this controlled selling. When you see controlled selling like this, it's a very good chance that something's up. And the market makers like to control sell down so they go higher. You can see right here, futures already up 20 over here, up 20 points in the futures market already, which I didn't even realize was open. I thought it was open at like 4 p.m. So now you know why. Very good chance. Now let's pull this out to the daily. Let's get rid of this. Very good chance that tomorrow we're going to see stocks go higher and probably rip roaring higher. That's my guess. Anything can happen, but people are always asking me like, well, it's a bear market, right? Well, kind of. I mean, so let's look at these trend lines real quick. I just want to do this. I'll do Tesla and then we'll go, oh, Bitcoin's up $700 also after the bell. So when you look at these trend lines, the third touch is like the most reliable one. So you start up here. This was the top. This is back in January 22 for the S&P, up at like 4,800. Now we go over here. That's our first one. Here's our second touch. That gives us a trend line. The third touch right here, this is in August. So August 15th, that is the safest expectation, safest play using this trend line is the third touch right there. Bing, and man, did it fire lower from there. Whew. And created a lower low, which made everyone believe that the downtrend was still in place. And then when we come back up, we touch it again. I actually touched it twice. We touched the same trend line 2 more times, and then we head lower again. But notice here, when we head lower, now we make a higher low. So we have the lower low here, higher low here, and then we make a higher high. So now we have a break of structure. So now the downtrend is broken. We have a higher high and we have a higher low. We do not have a change of character yet. We would need to get above this right here to really have a change of character. But this also, though it doesn't look like it, this is also a higher low. So we have low, higher low, higher high, higher low. And then this is our first lower low. So this is where it gets confusing on, is this bullish or is this bearish? Which way is the market going? It's very confused right now. It's very confused right now. You're getting mixed signals, but we are in an upward channel and we're around the middle of it. So we could sell off a little bit and still have an argument for bullishness. Or we could have earnings beats like we had today after the bell, and the shorts could get their faces ripped off tomorrow. The stocks would just go insanely higher. I do expect this was my favorite bounce area for Tesla. So I've been accumulating Tesla. Been waiting for the third touch on this line right here, which we have not seen yet. But when we do, it's going to be significant. And if it happens up against this resistance, you can just count on. I'm actually by puts. It would be so guaranteed to go lower. This area right here. Okay, we had a gap up here, and I was kind of expecting maybe we'll fill this gap. Maybe we go down to 145. I have bids in if we do. But we sort of stopped here. We sort of stopped in this inflection area, this inflection zone here. And what do we see if we zoom in? Sort of looks like that controlled selling we were talking about, right? You see how that's set up right there? This is much smaller scale. I'd have to pull this into a different chart, but you kind of see that controlled selling going on. So I think that the market makers know what's going to happen before we do. I think they knew that these good reports were going to come out after the bell today. I think they tried to get retail to sell today and get out of the way and to dump their stuff so that they could come in and buy it from them and profit from it tomorrow. We will find out if I'm right about that or not. Hard to say, but I do expect, Tesla to be volatile. They did not have a great quarter. This past quarter was not good. Okay, wasn't terrible, but wasn't what you expect from a growth name like Tesla. That's okay. They're going to have quarters like that usually presents buying opportunities. I've been scaling in for some time now, and I'll continue to do so. I do think that's $1,000 stock just waiting to happen. It's just a matter of time. That's pretty much it. Okay, let's do this. Let me pull this guy up over here. Let's pull some live rates. If you have a scenario that you would like to see, let me know, and we will pull it up live. A couple questions here. When rates start to go down, rates have been going down. If you look at the peak in interest rates was in October, so we're actually coming down from that. So it just depends on your perspective. If you look at 3 years ago, you'd say, oh, well, rates are up since then. But if you look back to October, which is 6 months ago, rates are down since then. So I would say rates have been coming down. As far as when we're going to see the fours again, when we're going to see the threes again, expect the soonest would be sometime in 2024. But I'm hoping and expecting rates to just slowly trickle down. And that's really the best thing that could happen for the market on all fronts. The only bad time to buy a home is if you don't love it or don't plan on being in it for a long period of time. Ultimately, you just have to look at what are your options. Your options are I can rent, and that doesn't really do anything for me. Or I can own, and that could potentially do a lot for me. But what are the potential drawbacks? Maybe I buy a house and I end up not liking the neighborhood, or I end up not liking the home, or I end up wanting to move. There's some risk. It's a commitment. And that's what's hard about it. Not just that it's expensive, but that it's a commitment. It's a big commitment. But it's the kind of commitment that you need to make at some point in your life because you don't want to rent forever. Don't want to rent forever. A lot of people ask me that question. Okay, let's do some live rate pulls here. See what we got. If you want to, I'll leave the comments open. If you want to let me know, we're going to use, so we use 780 credit here. We're going to do VA. Let's do VA high balance first. Let's see where this comes in. See who's cooking today. You have a scenario, a loan amount, anything like that you want me to post, I'll do it, or pull up, I'll do it. Just give me a shout and let me know. So we're looking at VA high balance here right now. AFR, the winner. Look at that. This is why being a broker is so superior. So 5.75. And they're basically just coming in. They're basically just coming into buying market share. That's what's happening. When a wholesale bank is slow on business, all they have to do is lower their rates and the business will come in because every broker is looking at this. AFR going to be there. How far away is UWM? Not too far. Not too far. You pay a little bit for 5.75, but that's gotten better since even just earlier today. So things looking good on that front. Okay, now let's check conforming balance. So we'll switch this to 700. And this is all with no money down. Looking at detached. 780 credit. Okay. I don't know, 1 unit. No fees, no points. This is just the naked rate sheet. So you go down to conforming balance. What happened to what happened to AFR? Where'd those guys go? See, and that's the real power in being a broker right there, is that depending upon the product, depending upon the day, depending upon the situation, somebody might have a better rate than somebody else. And I don't want to be married to any one of these rate sheets. 5.625. That's what it was this morning when I checked it. 5.625, conforming balance, VA, no points. And in fact, I'll give you $243. How about that for a $700,000 loan? Okay, now let's check FHA. And it should be relatively similar, but we're going to try to remember these. Let's see, 4% of 28, so 672. Get close. I can do 4%. 3.5 is hard to calculate mentally. Okay, UWM for this one, conforming balance again, 5.625, slightly better on the credit side, but basically the same, 5.625. And FHA, VA do tend to run kind of in lockstep with regard to that. All right, let's try a high balance FHA. And we'll do conventional. We'll look at some jumbo stuff. 4 to 36, so 764. Remember, you can buy $1 million home in San Diego County with FHA and only need 3.5% down. Isn't that crazy? 3.5%. It'll get you there. Okay, so high balance FHA also at 5.625. So we've got 5.625 for conforming balance and high balance for FHA, whereas the high balance for VA was 5.75. So a little bit of difference there. All right, now let's do some conventional scenarios here. Let's do this. Yeah, let's do this. This is a high balance, conventional, 5% down. So just doing minimum down payments here. Obviously, you have bigger down payments, rates go lower. I'm not going to sit here and run a million scenarios, but I just want people to, I want to be transparent and just show what's going on. JMac is in the house here. So high balance. Our mouse. Okay, high balance here. I knew there'd be some imperfection. Look how weird the market is. You want to charge me $12,000 for 6.99%? But 6.5 only costs 8,600. Market is weird sometimes. All right, so for $8, 7% seems to be like the way to go for $8. Skip your Starbucks, get a 7%. That's a high balance. This, I believe, was at 6.99% earlier today. So really close. Now let's check conforming balance. So we'll go down to 700. 5% down will be 35,000. So 55% down. By the way, Riverside County, the FHA limits are up. So FHA is much more possible now in Riverside County, 644,000. And there's First Citizens. There they are, 6.25. So you get 6.25 versus 7. So big difference there, right? Big difference. Let's go back to our heat map. Remember this? What we just did was 780 credit. Okay, 5% down. So supposedly, greater than 5%, less than 5%. So 5% down or less, I guess. Supposed to get a little love, actually. So this is why it's important to kind of look at the whole situation. 5% down, you're getting a little bit of love here for all credit scores. So the lower down payment is actually better across the credit score spectrum. The lower down payment is actually better. Isn't that interesting? So it's really the down payments. And like you said earlier, the 720 to 760 with 15 to 20% down. Those are the people who are really taking it on the chin the most. 20 to 20, I guess 15 to 25% down. That range right there is where it's the ugliest. And by the way, even punishing people with 680 to 699 who are putting 15 to 20% down. By the way, a 680 credit score, the average credit score in the nation is 696. So that's an average credit score person who's also being punished, by the way. Okay, let's see here. HELOC on my investment property, couldn't find any lenders, so I have to move back in. Could I do it the first month I moved there? Yeah, very true. They don't like to do HELOCs on investment properties for whatever reason. This just is what it is. You are correct. Yes, it has to be a primary residence for a HELOC in that situation. But overall here, I mean, the changes that have been made, not as far out there as it may seem when you really look at everything and you look at the context where we're headed. What will be interesting tomorrow, the most interesting thing will be if we do see a big pop in stocks as a result of these after hours big quarters that came out. What will happen with mortgage bonds? Will mortgage bonds react negatively to that and skip back down here, causing rates to go up? Or will we have just kind of an all green day and see everything move higher? That'd be pretty cool. I'd love that, right? Wouldn't that be great? Let's just send everything. Just moon it all. Moon the stocks, moon the cryptos, moon the bonds. Let's do this. I'm so down for that. We do not have any crazy data tomorrow, but there is some stuff to keep an eye on. I don't think any of this is really going to move the market as much as, these guys. I mean, these are the big, Microsoft, Alphabet. I mean, those are the big tech names. Those are market movers. They're going to move the market. That's what's going to matter tomorrow. in my opinion. We'll see what happens. And then just don't forget, we're going to keep an eye on these forecasts that Fannie Mae is putting out, not because we necessarily trust them as gospel, but because we want to see how they're revising things. They continue to revise things more and more bullish. Just remember, your boy told you what was going to happen this whole time. Haven't been wrong yet, and I won't be, because this isn't rocket science. That's probably the best thing about real estate, is you don't have to be a genius. You don't have to have perfect timing. You don't have to read some book and figure it out. All the people I know who made a ton of money in real estate did one thing. They just bought it. That's it. Bought it, held on to it. That's it. Nothing else is needed. You guys want wholesale home loan rates with no lender fees? Give me a shout. Text me, call me, email me. Remind me to turn my mic on. Thanks for that. Appreciate that. Try to do more of these. I got to get to work though. I got to take those calls. I'll be available if you need me. Have a great day. Talk to you soon.